Hey everyone, so today I wanted to talk about rates dropping, mortgage rates dropping, although interest rates are still increasing. So a lot of people are confused as to why are rates dropping in the mortgage industry while the Fed funds rate is still increasing. Well, at the making of this video, the Fed's funds rate is at 4%. And so, if a bank that has multiple millions or even billions of dollars, like a JP Morgan Chase, Bank of America, Wells Fargo, and others, can borrow from the government that has never defaulted or missed a payment at 4%, then it is more risky for the bank to lend to a regular consumer such as me or anyone else. So with the bank being able to lend to the Fed at 4%, essentially risk-free, they need to charge a premium on top of that to lend out to an average consumer. With the Fed hiking rates to well over 7% now, the banks were forced to make a decision, which was to lower their floor a little bit and do a little bit of math, which they haven't had to really do in the past because debt was super, super cheap. So they never had to really figure out what their floor would be when speaking with consumers and others. However, banks are starting to now look at what is risky enough to take on for the money that they're giving to average consumers such as us. With that being said, at this point in time, they have deemed that it is not necessary to have rates at 8% or anything close to that. And so rates have now lowered by a few basis points on mortgages compared to it being at just around 7% before. Now you can probably get a mortgage at 6.8 or 6.7%, depending on your credit score. So this has increased buying demand by 2% as the making of this video, but 2% isn't really enough to shift every consumer into wanting to buy now. However, you do see a surge of people who are like, okay, rates went down a little bit, let me go in and buy. And I also believe that although rates are still probably going to go up in the short term, when it does go down slightly, you're going to see a lot more demand. So for example, if rates go to 11% and then it goes back down to about 9.8, you're going to see a surge of people who want to get a mortgage under 10%. But right now that mortgage rates are right around that 7% mark, they don't necessarily want to buy in. But I'm telling you, when those rates go up to probably 11% and then it goes back down to around 9-ish, there are going to be more people than before that wanted to buy in because now rates are lower than they were when it was at 11%. It's not logical, but if people can afford it, they can do whatever they want to do with their money. What I would suggest is just finding a baseline of debt that you would like to be at, and if you don't meet that debt level, then it's not your time to buy. Now, another suggestion that I would make is if you don't own any home whatsoever, then it may be important to just look for something that you can afford that isn't just a crappy environment to be in. So if the only thing you can afford is to live in a place that is very undesirable, then it's best to just continue to make money in other ways via the stock market or some high interest CDs at this time. There are CDs that are at 4.25%. If you can lock that in for 2 or 3 years, that may give you a better return than the stock market in the short term, I would say. And I do believe that inflation will be under 4% in the next 3 years. So with that being said, you should be making more the inflation inflation is going up, essentially. This isn't going to change your life drastically, but it's going to help you to build that nest egg in order to purchase that first primary residence or just do more in general. So, for example, prior to me getting into the real estate industry, I had created a certificate of deposit account for 2025, and that was at 3.15%, which I thought was really, really good at the time. Now they're rates at 4.25, which is even better. So I would suggest anybody who doesn't have a lot of income coming in and is still trying to aggressively work on that, and they know that they're years away from purchasing, that might be a nice extra side investment to make, especially at this point. A 4% rate or higher is an investment in my book, and so I would look at that in terms of just gaining a little bit more on your capital. $400 a year off of $10,000 is going to continue to, you know, put a little bit of that cushion towards your investments. And so as I look at it, the 2025 rate that I have, I didn't even, of course, I didn't use it to buy the first two properties I have, but I still look at it as something that can be useful to me in the future when 2025 comes. Just having that extra income might be a big benefit to me in the next investments that I try to go in. And of course, I'm still investing now without it. And so, the way I look at it is just like never knew you was there. Thank you for coming back in my life. Time to use you to do X, Y, and Z. And especially if you're someone who spends a lot of money and you just came across a lot of money recently, this may be a good opportunity for you to put it in a CD that is over 4%, because this is going to allow for you to not just touch that money right away. I know there are some people who invest in the stock market and then they pull their money right out to buy the next latest thing. So CD is going to stop you from doing that because you don't really gain any interest on it in the first 12 months. Very similar to, the treasury bonds. Now, of course, you do gain some interest. I believe the first 3 months would be taken away if you decided to pull out of your CD account. However, I don't think at 4% it would be a substantial amount, and you would probably regret pulling out for any other reason. So if it's not an emergency, you probably won't look towards pulling out of your CD for something that's not as important as an investment or a medical issue or something like that. And so I do see a CD being very beneficial to some people at this time. Now, if rates continue to drop, which I don't foresee, then of course I would see a buying opportunity for a lot of people. Housing prices have dropped a little bit, and then with rates dropping, that should definitely create a buyer's opportunity. However, I do think housing prices are going to drop a little bit more over the next coming months. And if rates stay where they are, then that will create an additional buying opportunity when rates do drop a little bit more.